Hello and welcome to today's webinar. This is CraneShares 2025 China Outlook, the impact of policy, reform, and U.S.-China relations. My name is Brendan Ahern. I'm the Chief Investment Officer of CraneShares Exchange Traded Funds. I'm joined today by my London-based colleague, Dr. Xiaolin Chen, our Head of International. And what a momentous time to be talking about not just China, but particularly U.S.-China political relations. We believe that a thawing of U.S.-China relations will occur under the new Trump administration. Already, just over this past weekend at the inauguration, you've seen significant dialogue occurring at a high level, something that realistically did not occur under the prior administration, as well as chatter of a Trump-China visit within his first 100 days in office. While the art of the deal necessitates the threat of 60% tariffs, we believe that campaign rhetoric will not become economic reality based on the experience of high U.S. tariffs and their disastrous effect on not only the U.S., but the global economy in the 1930s. For this particular president who's obsessed, infatuated with the U.S. stock market and the U.S. economy, would implementing such disastrous economic policies make sense to you? It doesn't make sense to us neither. It's for that reason that we believe this geopolitical overhang can be removed, which would allow many global investors to reallocate to China. We think the timing could be very auspicious, not just based on low valuations, but based on what we saw beginning in September of last year, which is an incremental stimulus being implemented by the Chinese government, something that continues even just overnight, a big press conference that took place. While we believe that China's economy faces challenges, particularly around the real estate crisis, we believe investors don't recognize the size and scale of the policy support that's being implemented, nor its trickle-down effect occurring in the economy today. Please proactively ask questions over the course of the presentation, as Xiaolin and I are looking forward to a healthy Q&A. If you're joining us on craneshares.com, please email us at info@craneshares.com. As well as if you'd like to receive today's presentation, again, please email us at info@craneshares.com. If you're joining us on Zoom today, you can use the Q&A button. For CFP, CIMA, and CPD continuing ed credits, again, please email us at CE, that's Charlie Edward @craneshares.com. Very briefly, for those of you who are less familiar with CraneShares, I'd like to briefly provide an overview of our founder, Jonathan Crane's vision on forming CraneShares back in 2012. That vision was based on his experience not only living, but building a business in Shanghai geared to China's growing urban middle class. During that experience, Jonathan formed two core beliefs that were the building blocks for the foundation of CraneShares. The first is that new China economic sectors such as domestic consumption, internet, e-commerce, semiconductors, and healthcare have become important parts of Chinese economy. They've been underrepresented in global indices. The second foundation was the opening of China. That Jonathan's arrival in China in the beginning of 2001 was actually when the first foreign investor was allowed to invest in Shanghai and Shenzhen securities. That first opening of the door to mainland Chinese markets, Jonathan saw and experienced how that door was opening, and that liberalization could allow for Chinese equities to be added to global indices, something that did take place several years ago. Jonathan felt that the addition of Chinese stocks, the second largest stock market in the world, would have a material effect on global indices, as well as it would necessitate global investors to have a partner, a trusted partner. CraneShares endeavors to earn that trust through our research efforts such as today. If you fast forward to today, we've built a suite of China exchange traded funds, as well as we've diversified and pioneered the investing in carbon credit allowance futures, as well as we've worked with third-party managers such as Mount Lucas, Nancy Davis of Quadratic to make their strategies investable in a ETF. We've also more recently partnered with macro research firm Hedgeye to incorporate their risk management feature to owning U.S. stocks, as well as even more recently partnered with the world's largest publicly traded hedge fund firm, the Man Group, to make their strategy of applying private equity buyout ratios to public equities. And Xiaolin and our team in Europe has more than established our presence in the UCITS structure. But let's dive into the heart of the matter, which is what's been occurring more recently in China and China's capital markets. And I think many investors have actually not been aware of how well of a performance Chinese equities had in 2024. I think every conversation here in the United States is about Mag 7 and US tech, but the reality is China held up quite well, even versus the S&P 500 with its very, very high weight to a small number of stocks, particularly US tech stocks, handily beating developed markets as well as EMX China. On the next slide, I think it's important to show that we think because of some of the geopolitical narrative, a lot of money that had been previously invested in Chinese equities went into not only the S&P 500, but certainly into markets like Japan and India. And what's interesting is if we look at a year ago, literally a year ago yesterday was actually the bottom in Chinese stocks. And subsequent to then, our flagship ETF, the KWEB ETF, is up 25% versus the S&P 500's 26%. Japan, MSCI Japan is only up 4.5%, and India is only up 7.7%. So on both an absolute and a relative basis, Chinese stocks, particularly growth stocks as represented by KWEB, have more than held their own versus US stocks, but certainly relative to other markets. And that's a trend that we think the higher highs and lower lows is something that we think many investors have missed, because yes, we've had these pushes forward and we've had some pullbacks, but the end reality is higher highs, higher lows is what a technical analyst would call an uptrend. Now, again, I referenced this overhang of geopolitical. Our views around where the Trump administration could be going is based on our relationship with a trusted partner and trusted advisor to Crane Shares. Terry Branstad was President Trump's ambassador to China and during his first term. And Terry got that job based on his experience as not just, he was actually the longest running governor in American history, representing his great state of Iowa. But he earned that role because back in 1985, Terry hosted a delegation from Hubei province. Some government officials from the province were visiting Iowa, and he basically shepherded them around Iowa for 2 weeks. And incredibly, Terry actually kept up a relationship with those government officials, one of them whose name is Xi Jinping. So President Trump tapped Terry, not just because of the great trade relations Iowa has, soybeans, corn, soybeans to China, but also because of his personal relationship with President Xi. Now, what we believe is that this new administration led by President Trump, a business person, someone who's very much focused on the U.S. stock market. And remember, many of those U.S. multinationals have very high China revenue weights. But certainly the importance of the U.S. and China trade is why we think a potential thaw could be taking place. And remember, the previous administration, there was never the opportunity for a deal. On the next slide, we think it's important that already we're experiencing a very, very high level member of President Xi's inner sanctum, one of his trusted advisors, not only attended the inauguration, but met with the new vice president, J.D. Vance. He met with someone who is close to President Trump, but also close to China, someone who has a very, very strong economic interest in China, Elon Musk. Already we're seeing a material change from the past administration. The past administration, there was no offer of a deal. There was very little low-level contact at a low-level or high-level contact. Certainly the new ambassador, we believe, also from a agricultural state, will have a material impact on the relationship. It's happening. It's happening right now. Now, on the next slide, one of the things the previous administration did on its way out, and it's become an unfortunate effect we've seen in the changeover in power, is the outgoing administration trying to create problems for the new coming administration. And there's a whole host of issues that the outgoing administration threw gasoline on fires, but one of those was with China. And just prior to the new administration coming in, the Department of Defense added Tencent, the gaming company, the social media company in China. They added it, saying it's affiliated with the Chinese military. That is just a simply ridiculous statement. But investors shot first and added, didn't ask questions. I would certainly say that the company's response should be commended. They immediately stated that they would appeal to the Department of Defense to be removed from that. If that appeal is rejected, they will sue in court. There is a precedent for what we're seeing taking place. Xiaomi was actually added to a divestment list, and I think that's one of the confusion, is that the list that is done by the Department of Defense is not a divestment list. The divestment list falls under the U.S. Treasury's Office of Foreign Asset Control. That is a separate list. And yes, there is some overlap between the DoD and the OFAC list, but they're totally separate. There's no interplay between the two. And we think investors made a mistake in thinking that Tencent would be delisted. It is not on the OFAC list. And again, it took about 2 months from Xiaomi being added to the divestment list to a court in the District of Columbia throwing that decision out when there's no evidence could be supported. But more importantly, I think something that we've seen, Jiaolin, is on the next slide, is a number of investors coming in to buy the dip. Tencent fell about 10% that first day. And on the left-hand side, we showed that investors in mainland China increased their position in Tencent very dramatically by buying through the southbound Stock Connect. And on the right-hand side, it's just amazing to me, Jiaolin, how much stock the company Tencent actually bought prior to the being added to this DoD list. Tencent's been buying about 1.6 million shares in Hong Kong, 700 HK, and they immediately increased that percentage very dramatically to just about 4%. So they're actually accounted for about 15% of the trading in its stock, just amazing to see that support. And again, we can get you those exact numbers over the course of the last several weeks coming from the company themselves. Now, one of the challenges that is occurring in China is related to a collapse in real estate prices, the knock-on effects of the potential risks associated with distressed real estate developers. On the next slide, and the fall in real estate prices has had a material effect on the balance sheets of urban households who have upwards of 2/3 of their wealth invested in real estate. And that's led to a collapse in consumer confidence as well as domestic consumption. And this effect is a very real effect. Just imagine, if there's less real estate being built, that means less construction workers, electricians, plumbers, cement mixers, you name it, as well as it means less new home furnishings. So the upstream and downstream effects around real estate is very much real on the economy. And on the next slide, that's why we've seen we had incremental policies, but really in September, we had the proverbial policy bazooka. And Jelen, I know we've seen some really material policies from the PBOC and from the government.
I would agree. 2024 does, particularly on the date we mark on 24th of September, when they actually did the press conference and announced all these policies announcements. That's really truly a game changer moment for China. So step up on easing on policies from all front, including mortgage, corporate borrowing costs, cutting immediately the lending rates for household, giving almost 150 billion RMB interest, the mortgage interest paid back to the household immediately with an immediate effect. That's an immediate injection of household income back to the people. I say, September, obviously, by now you have read all the policies, all the details and numbers. But one thing stood out very much for me, firmly believe this is a moment of completely changed in tone, was how the policymaker delivered that message. Over the last 2+ decades of covering China, I've never seen Chinese policymaker speak that way in September. They were almost like a 500 billion stock swap program. Is that enough? If not enough, let's do another 500 billion. And if needed to be, we do another round of 500 billion. This is reminded me the moment of Mario Draghi, ECB said, we do whatever it takes for Europe to back on track. This is China's moment. We do whatever it takes. Obviously, the areas, the policies will touch or will providing us support is massive, is beyond market expectation. One, and also the tone of the message they delivered at the conference, and thereafter all the other meetings hosted in November, December, the working economic group, so on and so forth, all the press conferences they speak, they keep very consistent tone of the messaging, very consistent of implementing the policy. That's the third point I say give them the credit, is from announcing a such large scale of policy to implementation took them about few days. That's a huge credit to say we do what we really meant we want to do to help this economy. So that's a huge credit to the Chinese policymaker. And then into the new year of 2025, we expect nothing less. They have already proved us to be on the right track. If you read Brandon's daily blog, China last night, you will see all the recent developments in helping on potentially issuing more central government bonds, and the 2 sessions that potentially have more, announcements on policies. On the next page, we showed some of the policies, and today, literally at the press conference hosted by CSRC's boss, Mr. Wu. By the way, this is a person that we know really for a long time. When he take the office, John and I literally want to meet with CSRC. It was very clear he want to help with the investor. He want to rebuild the confidence. You want to do whatever it takes for the Chinese capital market to become healthy and solid again. So today, even at the conference, he announced, the insurance company would have to reinvest 30% of the new premium to the A shares equity per the end. And also the mutual funds, every year you need to increase your allocations to China, including also the pensions. Every year, your Chinese allocation starting from 10% for the next 10 years, every year go up from there. It's a long-term money, sticky money, insurance money, pension money, all coming into this market. This is another wave of him implementing a very decisive policy to have a long-term, fundamental support to this market. Obviously, in the two session or in the coming months, that we have quite a lot of key events to be happening. March, this is where we have the do session. It's really the National People Congress. This is where you're going to see the economic targets, the budgets, and so on and so forth. Streets estimates have various of points, but really it's centered around 5% GDP. We think that's very realistic. It's a must achieve target for China to achieve the urbanization goal for the next decade. We think they can continue to deliver the job. The other things will be very crucial to watch is all these structural reforms that they should implement. And remember, last year they also hinted a lot of policy is working in progress to be approved. We do think there's going to be some structural changes on, the social safety net and also the hukou systems. For those of you who are not really knowing what hukou system is, it's almost like your identity card. If you were born in city, like I was born in the city called Harbin, it's northeast of city in China. If you were born there, your identity ID card will say you from Harbin, and that's very much locking you in for all the rest of the reports in the system, namely education. You need to educate in Harbin, or you need to take exams to go to middle school, high school, university from Harbin, and also your medical records and restrictions for some cities that you can't buy a house in certain cities. So it restricts quite a lot of free movement and for people to remigrate or freely to different cities, large cities, namely. This has already seen huge improvements in hukou system reform. I give you one example. In the past, if you are from Harbin, you go to Beijing to stay there for 3 months of tourist or visiting your family, your healthcare system still stays in Harbin. You cannot go to the hospital, at least you cannot claim back the expenses if you occurred any in Beijing while you're visiting another city. Has to go back to your own hometown city. But now it has completely changed. You can apply, you can submit an application, and then while you're in Beijing, you can enjoy as much as you have as a healthcare a scheme you have at your hometown. You see a lot of improvement already. We expect this continue to be the case into 2025 and many more to come. I still think, physical front, they can still do a very big wave of spending. That's one, and central government bonds issuing. They haven't been doing that for over a decade and a half. Now, last year they first started. I think this is the right path. They all get oversubscribed. You can expect more issuance from central government to help with local governments' liquidity issues, so on and so forth, and many more of a toolkit they still have left, and they have either more rooms they can do, or they can still implement new toolkit like they did this morning to allow the medium or long-term sticky money to come into A shares market, to Chinese equity market. Brandon, I don't know if I covered everything you have in your mind.
Yeah, that's fantastic. I think it's I think this opportunity, you're seeing these stimulus definitely taking place, but I think it's also giving the government the opportunity to address some of these structural issues, the hukou system, where a lot of migrant workers aren't able to tap the resources in the cities that they're working in, and certainly the social safety net is fairly de minimis in China, and that looks to be on the docket to be expanded. And then certainly demographics is something that continues to be a concern for investors. But we would point out that the start of Japan's bull market actually started the year the population began declining. So I think on the next slide, one area where there's been a little bit of a stabilization in real estate prices. We've seen transactions based on some of the measures implemented. Transaction volumes are increasing, and it is a case, in real estate, they say location's everything, and that's true in China as well, that the tier one cities are stabilizing much, much quicker versus the smaller, tier two, three, four cities. But it also depends a lot, Jellen, just based on when someone bought. That if you bought
Exactly.
real estate 10 years ago, you're probably still up versus someone who bought 2 years ago. It might be a very different situation.
I would agree. It's really depending on timing. I think the audience sick and tired to hear me talking about my families, but it's a classic example of my mom is the first batch of people who literally left their job back in 90s to start their private business. So I have every right to see how we enjoyed the rally of rising of a private business and private, self-made millionaires and billionaires in the society. The house, my parents still living there because both my sister and I left. They still have a lot of memory there, so they didn't leave there. Our first house, they lived there now for nearly 20, 30 years. I remember when we bought the house, it cost us about 20,000 RMB. Back then, it was quite a lot of money. But his house at some point was worth 150,000, which is 7+ times up. Now it's probably about 100K, 110, 120K, still up substantially. Anyway, I think your point taken, and also important to note is Chinese household on average is not overly leveraged. The 2008 situation where it happens was a lot of the household is carrying a negative equity, which increasingly the risk of saying increased payments, increasing of negative equity carry can't afford it anymore. That's caused the collapse. And in China, that's not the situation. That's one. A majority of them are like to buy the house with cash, like my parents' age. They want to have the sense of ownership. I'd agree with you. I'm used to be very bearish on the housing market, not because anything wrong with it back then. It was really scarily of the rising in the price. But after 2 or 3 years of consolidating of the market, one on the price front, second on the borrowing cost, mortgage rates, and third is the inventory is really at a historical low level, and also the new product, new house starts is almost negative to nothing. With all these in combination, with plus all the policy introduced by the Chinese policymaker helping on the demand side, lowering the mortgage rates, lowering the payments, and so on and so forth, and removing the restriction for people to buy these houses. Now, I do see after 2 years or 3 years of me being a bit bearish on this, this is started to see the being put in place by the policymakers started to work. That's why you see the stabilization and also the uptake from this level. I think the surprise is going to be on the upside.
Yeah, and certainly just last week I was in Shanghai, and obviously being in Pudong, the kind of financial district, I was surprised at how much construction was actually taking place. And obviously Shanghai is different. It's a very wealthy city, and but there was a fair amount of construction taking place. But obviously the tier one cities are a little bit of an anomaly. I think one thing, Jalen, that's I think been missed by some investors on the next slide is that investors have been so focused on the words domestic consumption stimulus, and I think that those investors are not peeling the onion a little bit. They're looking at the explicit directives like cleaning up the balance sheets of local governments or the housing support, and they're not thinking about the implicit effects this would have on domestic consumption, domestic confidence, and I think that's been one of the things that we think the market is missing a little bit, is that these policies are implicitly focused on raising consumer confidence, implicitly on raising domestic consumption, even though they're maybe explicitly not, don't say it in the headlines. It's very similar as even one of the areas where we've seen an explicit domestic consumption policy on the next slide has been the trade-in subsidies, that if you have a older car, an older home, washing machine, air conditioner, you get a bit of a subsidy break. That does include electric vehicle and hybrid for auto. And we've seen some strong numbers for auto sales in China, electric vehicle. But I think what's missed is that a lot of these companies employ a lot of people. I think if you didn't look at the slide and I asked you, how many people do you think BYD employs in China, you'd probably say, maybe 200,000, but it's over 700,000 people. So if BYD and other automakers are selling more cars, which they're doing, it means that their workers are getting paid. They're getting maybe bonuses, and similar case around the home appliance makers. And on the next slide, certainly the effect on home appliance sales, very, very strong. They've actually extended these subsidies into 2025. And that, based on our view of looking at the employment effect of these consumer subsidies, we speculated that an industry that employs a lot of people in China was electronics, right? Things like this, things like my smartphone, my watch. And on the next slide, we basically looked at industries in China and said, what are the ones that employ the most people? And that's where we came to the conclusion of home electronics in general would be a great place. And that's come to fruition where they're offering us subsidies. Apple just yesterday lowered the price of an iPhone to get it below the max 6,000 RMB threshold. And we think that part of this, again, is because of the implicit effect it has on employment. And again, no one's talking about this, maybe outside of you and me, Xiaolin, and our colleagues. Really, really remarkable.
I'd agree because this program been taking up, promoted last year and then has been taking up quite well, particularly, from different tiers of cities across. And now they have more products, like you said, the electronics. If it's below 6,000, you have all sorts of different benefits to be added. You can claim them back, and then the merchants have to give you cash back. It's a lot of encouragement, promotions going on for this to take, and people are liking it. People are taking it. From the conversation I engage with onshore investors, they do see increasing number of people start to, and particularly on the previous page, you show the home applicants. That's a huge take for the household to be interested. Typically, those are quite dated. You use them for years, and now you're paying less than half of in overall cost you would consider to use them. And we will see those pick up, and particularly, in some of the promotion seasons, and this is approaching New Year, so we got to wait and see how the data will show. But I do continue to be optimistic on consumption side. And we often say this, a lot of people say, oh, they're not spending. China is not a liquidity issue. The Chinese household have the highest saving rates in the whole world. They're very high savers. They have cash in their bank account. Obviously, with this kind of promotion, bargaining, and so on and so forth going on, you would encourage household to spend. It's a question if, not like some other countries, they don't have the cash to spend. It's the opposite. They do have the cash to spend. It's a matter of this program to continue and give them large scale discounts. You'll see a huge pickup, like we did I know we have some pages on Singles Day, Double 11. We can show that. That's one classic example to see it's going up by multiples.
Yeah,
There you go. That's the page.
Yeah, exactly. Yeah, I think this Singles Day, because the Singles Day is no longer a day. It's actually, you have these pre-sales that actually took place in October, and lo and behold, October retail sales was much stronger. November was maybe a little bit light just because Singles Day, they pulled forward some of those sales. But really, I think this is what gets me excited, is that I don't think anyone is talking about how successful Singles Day was and what that should mean for the e-commerce companies in that space. I think the only other person who maybe is talking about this on the next slide are the sell side analysts who cover the underlying
I
stocks
was just
that.
going to make a joke, Brandon, on the single
Sure.
stay. Just on the single stay itself, is 701 million puzzles delivered. That's like Americans, everyone has to order 2.5 puzzles.
It's it's a really, I mean, yeah, it's just a remarkable some of
Oh,
the
nation.
yeah. I mean, in general with China, the numbers get big fast, and my keyboard, the comma is worn out. But I think where you're seeing one financial professional who's picking up on this are the sell side analysts that cover the K-Web companies, and that's not true for all of MSCI China. I mean, just if you think about energy stocks and material stocks are going to be very dependent upon commodity prices. The banks, which are a big part of broader indices like MSCI China, the yield curve is very flat. It just makes it hard for banks, but the internet is an area where we're actually seeing earnings expectations are arguably in a positive framework relative to the rest of China, of MSCI China. The other area of where we're seeing actual interest in the space on the next slide is from the companies themselves. And we've long argued that one of the interesting elements or aspects of KWEB, our China Internet ETF, is that just about every single stock within KWEB, the founder is either the CEO or the chairperson. If you think about, sure, Jack Ma is retired from Alibaba, but Joe Tsai, a co-founder, and Pony Ma at Tencent, Richard Liu, Robin Li, a whole host of these China's tech giants are still running their companies. And what's interesting is this buying of stock that we've seen in a very significant way. I mentioned Tencent, that they're buying just about 4 million shares. It's been running at almost 15% of Tencent's volume in Hong Kong is from their buyback program. In the case of Alibaba, it's about 1 to 2% of their ADR volume is actually driven by their buyback. And again, if you are a tech entrepreneur, as the founders of the companies in KWEB are, your net worth is in that stock. And if China's economy was doing so badly, or if they felt that their company's prospects were so bad, wouldn't they be hoarding cash and not using it to buy back stock hand over fist? We just kicked off earnings season for KWEB. TAL Education reported earnings. The company grew revenue in the quarter 62% year over year, and the company actually swung to profitability. So a good start to the KWEB earnings season. But again, I think it's a very important in poker. They would call it a tell. The companies are telling you their stock is cheap. On the next slide, the other buyer is mainland investors accessing the KWEB companies, the growth stocks in Hong Kong via southbound Stock Connect. In 2024, mainland investors bought $103 billion worth of Hong Kong stocks. That's more than double the 40 billion they had bought the previous two years. As you can see, year to date, they've already bought, I think it's about 14 billion. They bought almost 700 million today alone. So already a huge appetite from mainland investors. They buying predominantly the companies within KWEB. And we find that a very interesting because we believe on the next slide that the main reason a lot of global investors, and maybe this is a little bit particular here in the United States, many institutional investors have not been buying China, and particularly cheap China tech, because of the geopolitical. And that's despite those investors. If you're a CFA or an MBA, you're supposed to be buying, you buy low, sell high, but because of the geopolitical narrative, how do you go to your boss if you're at a big mutual fund family and say, I want to buy, China? Well, you're afraid of the next Western media headline, or, your board or your trustees. Where are they receiving their China information? Maybe it's from the Western media versus where it should be, which is China last night, which is balanced and data driven. So the positive things in China never make it into the Western media narrative, and we think that will change under this administration. There is now some of that I mentioned is on the next slide is somewhat geographical in nature, and I think you're seeing that is not what some of that headwind from a geopolitical. Just yesterday at Davos, the largest institutional investor globally very simply said you should be buying low, selling high, and that meant buying China and selling U.S. tech. And I think this is an investor who's not encumbered by some of the geopolitical narrative. So some will move faster than others. There is another investor that's moving, and that is hedge funds. And certainly there's been a number of prominent, really, investment legends have mentioned that they're buying China. Now, obviously, hedge funds can hedge. They can utilize KWeb's deep options market, or they can trade around positions. But these investors, we believe, what their rationale is, one, that they just see something that's inexpensive on an absolute and relative basis. And so you buy. It's just that simple. You buy. No. Other investors maybe should need the volatility adjust that. But we do think one reason you're seeing some very prominent investors that we highly respect buying. We actually had the opportunity to see back in November in Singapore, Howard Marks speak, who said he's buying China today. So a number of these prominent investors have filed 13Fs with the SEC. Obviously, 13F is on a lag, so we don't know exactly what they're holding. But I think that the key is that these hedge fund investors are unencumbered by some of the geopolitical narrative. One, because of their ability to trade and hedge, but two is they're just there to make money, and they're not encumbered by the input of trustees and boards. I think another thing that we've thought about is that the new Treasury Secretary under President Trump, Scott Bessent, is actually a hedge fund manager himself. And I recommend an interview with Scott Bessent. It's on a podcast called Capital Allocators, where he was interviewed, and you come away knowing that Scott Bessent, who worked for George Soros, his mentor, Stanley Druckenmiller, Jim Chanos, famous short seller, he's a free markets person. He's someone that knows 60% tariffs would be an absolute disaster for the U.S. economy and the U.S. stock market. And we think, again, some of the campaign rhetoric will not become economic reality. That's our belief, and that's maybe what's led some of these investors in the hedge fund community to be involved in Chinese equities. But to conclude, we see two main catalysts taking place. The first is the geopolitical constraint, the improvement of U.S.-China relations under President Trump, who has a relationship himself with President Xi. Already, from what we're seeing, a number of positive signs, and that thawing of U.S.-China relations, we believe, can allow many global institutions, but particularly U.S. institutions, to do what they know they should be doing, which is buying what we believe is cheap China tech via KWeb, self-serving and highly biased. But we also think there's another catalyst taking place, which is the incremental implementation of policy support. And we're seeing some of those green shoots actually taking effect in the economy. in the real estate market. And we think as we enter into the Q4 earnings season for the K-Web companies, most of which will take place after Chinese New Year, we really do believe that there's an opportunity. Again, we believe that there needs to be some element of volatility adjustment, but we're very excited about the opportunity that we see taking place in China today. As we go through some of our compliance slides, Xiaolin and I would love to entertain some questions. And if you're joining us on craneshares.com and have a question or would like to receive the presentation, please email us at info@craneshares.com. If you're joining us on the Zoom today, please use the Q&A. Like we've got some good questions coming in already. So let's dive right in, Xiaolin.
Sure.
Okay, so yeah, but I think it's a good question from Yost. Just asking Xiaolin, Chinese stocks negatively affected by the new Trump administration, those listed on U.S. exchange. First and foremost, Tencent is not on OFAC's divestment list. We know that they're going to appeal the list that they're on. We think it's just a ridiculous designation, and that they will appeal that decision and will fight it in court. So no, we do not. If anything, it's interesting, Yost. I would argue that one of the core tenets, one of the real Trump trades has been buying financials. We actually think China is a Trump trade. But if you think about, if you want, as we know, President Trump wants healthy capital markets and financial sector. That really means you don't want to remove companies from exchanges. You want to add them, right? So I do think that's a factor. And I'm not sure, just maybe from your perspective, from the European perspective, Xiaolin, just maybe are there kind of views that you're seeing?
I think many of these companies chose to list it in U.S. exchange was really to the American dream, make anything happens. Also some, of course, mechanism reasons of why they list it in New York, like why Baba wants list in New York instead of Shanghai. Long story short, but I do think it has to be very carefully thought of, because it's come to choose to list it in U.S. It's not for the reason of in the middle of the storm. It's more of like to offer the access to global investors. I think I used to also ask like what Chinese stocks will actually profit the most from all these stimulus packages. I think Brandon, I don't know your take on it, but I think while I was listening to you answer the first question, I was thinking through all the policies announced by the Chinese policymaker, all the stimulus package, either to provide mortgage help, support on the lowering rates, all these job creation, so on. So it's really helping on the demand side. It's really helping the household. It's really helping on the consumption side. So in some of the meetings, I talked to the clients in the way of like the first wave of the broader beta release happened in September. Now is transitioning to staging 2, which is now these sectors that will benefit the most from these stimulus package are consumer related sectors and are consumer power to recover. And I think now is the sector that related to consumer would lead the performance this year in 2025.
Yeah, and I think it's a good point, Jalen, that the U.S. listings is that dream, and we didn't really talk much about TikTok, which obviously has been its demise staved off by President Trump. We've had this reprieve, but I think it's important to investors to understand that TikTok's parent ByteDance is 60% owned by foreign investors, predominantly U.S. private equity firms own ByteDance, and those 4 of the 6 board members are Americans, and we've always been skeptical that any U.S. politician would make TikTok a zero, would ban it, because the end investors who own TikTok's parent are probably your college, your alma mater's endowment, or your favorite charity's foundation, or your pension fund. That these U.S. private equity firms that own ByteDance are investing on behalf of U.S. institutions. And as a politician, you're going to make that a zero. I'm sorry. I've always been very skeptical of that narrative, and this use of China, that ByteDance, some sort of foreign adversary, it's ridiculous. It's basically an American company. It just happens to have operations in China. It is owned by Americans, and it just is part of this media narrative that I think is going to go away under this new administration. The lack of fact checking, the lack of talking about inconvenient truths, and I'm looking forward to a thawing in U.S.-China relations under this new administration, and I really do believe it's happening. And again, money will come back as that geopolitical headwind goes away. One thing, it's a good question from our friend Brian, just asking, this valuation gap between U.S. and China, internet names, tech plays. And it's one of the things that we actually kind of skipped over that slide actually, Brian. But what I was going to mention is we don't believe valuations are a catalyst. That the one thing we've noticed over the last several years is that these valuations can persist. There we go. That yes, things can remain cheap. The famous saying, markets can remain irrational longer than you can take solvent. And I think that what our counsel has been is that, while we see valuations that are inexpensive, our main catalysts today are more driven by the geopolitical narrative changing, the stimulus taking place, but really the buybacks, the shrink float adjustments. That's these companies, their shares outstanding is getting smaller. The buybacks, the buying from mainland investors, and as we enter into the Q4 earnings season, we think that's something where we can maybe start to see that valuation discount come in a little bit, tighten a bit.
Brandon, I think Juan asked a good question on your recent trip to Shanghai. Is literally asking how you feel about the economy. It's word by word of Juan saying the sentiment is not the best guts, but how do you feel? Like you visited Shanghai, wasn't that's a few weeks ago, week or two?
Last week.
Last week.
Just got
Very
back.
fresh. Very fresh. How do
But
you feel?
I would say, one thing is visually, whenever I've gone to China over the last several years, you'd think based on the Western media narrative, you think buildings are on fire, or that malls are empty, restaurants are, and it's never been that case. It's never been that case. It always feels now, and I'm probably biased that I'm going to tier 1 cities, if it's Shenzhen or Shanghai or Hong Kong, and I'm staying in probably a nicer area. So there is some bias to what I'm seeing and experiencing. But this last trip, spending a few days, I thought probably, Xiaolin, the thing that was I spent some time in Hong Kong, and because I stayed over the weekend. I went to Macau with our colleague Brian for the first time. We took the ferry over. And that to me was more telling, that this is in advance of Chinese New Year. Macau was just absolutely packed to the gills. I mean, you go up to, I think it's St. Peter's, the ruins of St. Peter's Cathedral, and just the mass of humanity is like nothing. I mean, you're just crammed in there to see these tourist sites. We did go in Old Town. We went to the Wynn, which is a high-end casino.
Yeah.
And it was moderately crowded. I would say it wasn't packed. It wasn't, but it wasn't empty. It was just moderate. And there, the minimum to gamble for blackjack and baccarat was, I think, about $75 US. Then we went to both the MGM in the newer area, Cotai, where you have these three, just ginormous casinos, the Sands, the Galaxy, and we spent some time in the Venetian Walk, and the packed. I mean, you just never. I mean, just like nothing you've ever seen. Just all the tables packed, and this was well in advance of Chinese New Year, and it's just a random Saturday. Just my takeaway was more of that. I just can't imagine what Macau would be like during Chinese New Year, if on a random weekend it was that crowded. So visually, I found it to be very incongruent. I thought in Shanghai there were a lot of conversations on property developers and real estate and banks' exposure to real estate, to property developers, which shows it's a very real issue. We don't discount that. At the same time, the government is very aware of the issue and is determined to do something about it. And so we think more kind of forward thinking. But I'm on Twitter, and I'll put up some photos. It's
Please do.
at @Ahern_Brendan. I'll put up some photos on Twitter, and certainly we'll try to get them into China last night as well, just so you can see it for yourself.
That'd be nice. Similar questions on Baba. I thought Baba overall, after implementing all the buyback, they probably reduced their shares by 14%. Have they done all of that yet, or do we know? It's also question Juan. I just see you right in the middle of the screen. So it's also from Juan asking thoughts on Baba shares buyback implementation.
Yeah, Alibaba, it's interesting. They're mainly buying the ADR, and what they've been doing is they basically dial up and down the buyback on a daily basis, based on what the stock is doing. It's kind of interesting. So, on last week, from January 7th through January 16th, they bought basically the equivalent in the ADRs. They bought 472,000, 479, 493, 494, 488, 484, 304,000 shares, representing in that span, they were call it 4 to 5, call it a little more than 4% of the ADR's volume. On days like this, on Monday on the 21st, they bought only 116,000 shares, and so they're only less than 1% because the stock went up. So they're dialing it up, dialing it down based on what's happening with the market, and it's just a tremendous effect we're seeing in the case of Tencent. The day before that they were added to, again, and emphasize, not the divestment list, in Hong Kong, they bought. They were buying the first week of January, they were buying about 1.6 million shares. And then when they got added to the DoD list, it's been running around 4 million shares. So they've been averaging, the last several days, more than 10%. They're actually 15% on the 16th. So they're buying back stock very soon. As we head into earnings season, a lot of times the companies aren't allowed to buy back stock. They go into a quiet period, and because the Hong Kong Stock Exchange requires a public filing on the day of the buyback, they have to kind of tap the brakes on that. But yeah, just tremendous buyback across the space, particularly from those two companies.
Right on time. What's your thoughts? You want to address one more question? Anything catch your eye, or I just be cautious on time for everyone who dial in here.
Let me just take a look. Yeah, we definitely agree with Bruno's thesis that a lot of the companies, our friend Jim. Yeah, one thing I've been a little surprised that our friend Jim mentions is that the K-stars kind of lagged a little bit relative to K-Web, and I think this is where a little bit of the disparity between onshore China, Shanghai, Shenzhen, starboard stocks, really representative of what consumer confidence looks like in China, the vast majority of those shareholders, and contrast that with the K-Web companies, the Hong Kong, US ADR growth stocks, predominantly owned by foreign investors. And I think even in domestic, in the mainland market, investors tend to gravitate more toward the Shenzhen and starboard stocks, the growth names. And I think the tepid market in the mainland market is kind of like a daily barometer for the government to know they have to keep pushing this stimulus pedal, that investors in China want to see more. And I think it's still early days in that policy support cycle. As we head into the dual sessions in March, we really do anticipate more budget measures, expenditures explicitly. So I think this is where foreign investors are going to be more affected by some of the geopolitical, where in the mainland it's a little more around the economy. But I know we're at the 1 hour mark, Xiaolin, and but certainly for this questions not answered, we'll certainly go through them. Please, we want to make sure everyone no question goes unanswered. But certainly, certainly appreciate the opportunity, and please, on any given day, please email us if there's questions, concerns, issues you'd like us to address. We're happy to do so. But yeah, certainly. Xiaolin and the team, our colleague Henry, for great work on the presentation, and certainly looking forward to a prosperous 2025, the year of the snake.
Happy New Year, everyone.